What's going on, folks? In today's video, we are going to be covering Intel. We'll do a fundamental analysis on this business. We'll run through the numbers, see what they're doing right, what they're doing wrong, and then we'll calculate the intrinsic value of this company so you'll know by the end of this video if Intel is a buy or if it's over or undervalued. So here's a quick story with Intel. This is definitely, I've covered this company a bunch of times, but the short story is this is a tech giant and they are the leading manufacturer of computer chips and CPU chips. Now, they've kind of lost their way over the last few years, but now with Pat Gelsinger at the helm, they're really trying to turn this ship around. So the short story of it is they essentially have been losing this AI chip race, but they've been investing a lot of money into their foundries so that they can start producing chips for other manufacturers, namely NVIDIA and AMD. So the cool thing about Intel is that they make their own chips. Now they want to also get into the spot of maybe competing with TSM and make chips for other people, which could open up another form of revenue. Let's take a look at this business. So currently it hit a 52-week high of, well, I guess $40 at one point. So $40 was the 52-week high. Based off the financial evaluations here, we are ranking this company a 7 out of 10. Now that score is not too bad. Now, what the financial evaluations does on this software here that I'm using called StockSpec, it takes a look at the company's financial strengths, the balance sheets, the cash flow statements, and income statements, and gives it a score out of 10, as I said, and basically kind of gives you a rough estimate of, hey, this is how strong this company is, and you can kind of use that going forward. Couple that with the company metrics, then you can cross compare what the company's done right and what they've done wrong. So with Intel, they're getting docked in 3 categories. Their share dilution, so they've been diluting shareholders, their net income, and free cash flow. So essentially what's going on in the free cash flow, and I've covered this in previous videos, is that they've been investing into themselves. So here's the important thing about free cash flow. Intel is very cash positive. However, over the last couple of years, they've been reinvesting into themselves. So they've been burning through their free cash flow and using that money to build different foundries. One in Arizona, one in Ohio, and I think one in Germany. I'm pretty sure. I know 2 for sure in the United States. I can't recall if it's in Germany or not in Europe. So that's where their free cash flow is going. Their net income is down over the last little while, which is not something that we want to see, but that's where it is. However, there's a lot of positives to be said. The price earnings ratio for Intel, I'll bring it just back to the board here, is currently sitting at 11.27. That means on average, you're getting Intel for a pretty decent price earnings ratio. We like to find companies of a price earning ratio of 22.5 and below, and comparing that to the average market price earnings ratio of 15, this is in a undervalued territory off this metric alone. The current ratio is pretty good. It's sitting at 1.60. It's just reached the threshold mark. That means they have enough assets on hand to cover those liabilities that we always talk about. We want to find companies that are secure in that way. The return on equity average is currently sitting at around 22%. So for what we want to try to find are companies that have a decent amount of return on equity as well as sticking within the trend. And 22% is actually pretty decent for this company and companies in general. Anything above 15 is kind of where you want to be. That's kind of the sweet spot I find. Their EPS growth is up over the last 5 years by 95%. So if you've been holding this company, you should be happy about that. And their debt to equity is sitting at 41%, which is great. That means they're funneling their operations through equity and not taking on debt. Especially, this is extremely important as we go through this high interest environment. High amounts of debt in a high interest environment is not too great, folks. Now, the revenue growth is up and their return on invested capital is also up. So some pretty good positives across the board here with Intel. However, everything else is looking kind of negative, where we have a negative price earnings ratio, negative EPS, negative return on equity for the trailing 12 months, as well as a profit margin. So they kind of got hit hard this year compared to last year, and it's quite evident here in the Piotrowski score sitting at a 2. Now this score compares past performance of the previous year to the current year, and so we want to find companies that are around 7 to 9, and that for us that's pretty imperative, just because we say, okay, we have the 5-year averages, we have the trailing 12 months, where are we from a year ago to today, and 2 is not looking too great. Couple that with the Almond Z score of 1.93, that is also a very shaky territory. This indicates to us that we're kind of in this gray zone, if you will. Now, the Almond Z score just measures the bankruptcy risk of a company. Anything above 3 is pretty solid. Actually, it's very solid. You have pretty much nothing to worry about. Anything below 3, 1.8 to 3, is kind of like this gray area, and it's neither here nor there. If the number is below 1.8, that is when you should be concerned, because that is where companies are in a level of distress and risk of bankruptcy may occur. Now, with Intel, they're currently sitting at 1.93. It's somewhere we don't want to be. But however, that is only based off obviously the numerics that we have currently, and a lot of money is being poured into these foundries. As I said, this is a giant ship. This is a giant ship, and the story is that they are trying to turn this ship around. And it's been a long-term play for a lot of investors. I currently own shares in Intel, and like, let me tell you, it's been some rough waters. I gotta tell you, but I have faith in Pat. I have faith in this company. I don't think this company is going to be going away anytime soon. However, this is, out of all my value plays that I've been making, this is the one that's kind of that pulls on the heartstrings the most, because it is very tough to stay with this company. But you gotta believe and have with conviction. I believe they're on the right course. It's just going to take a lot of time to for them to turn around. Now, with that being said, the numbers are looking pretty solid overall. I'll bring you over to just to show you what that means with the income statements, just to see what their revenue is looking like. Because here's the thing, folks: you have a $160 billion company, and just look at their annual revenues over the last like 10 years. You got 52 billion, 55, 59, 62, 70, 71, 77, 79, and now we just dropped down for the 2022 year, from 2021 to 2022. So it's a little bit of a dip. We're kind of hovering in that 2018. So, and also with their cash flow, bring up the cash flow statement just for a quick second. We also see that their net income is also dipped. So 2022, so the 2022 year was a rough year for them. But overall, on average, they're bringing in about $20 billion of net income. And in their revenue, they're also bringing around 70, let's say call it 70 to almost 75 billion on average, or 79 billion on average of revenue. So this is the one year that they got hit. Does that mean that it's going to happen for the next, let's say, foreseeable future? Possibly. So what I've done is to try to factor that into the price analysis section. Now, this section of the software here, I'm able to put some different assumptions in of what I believe the company is going to do over the next 1 to 20 years. I always do 10 years of analysis on this channel because to me that makes the most amount of sense. And I think about, okay, I'm going to buy this company, I'm going to hold it for 10 years. If I'm going to go in on it, I'm going to hold it for 10 years. So that's what I've done. And I've put in some low revenue growth numbers. So my thinking is, okay, they're going to regroup, and then from this point onwards, the revenue is going to grow by, on the low side, 3%, on the high side, 7%. And now that may be very, very conservative to some people, but this is where I currently stand. Along with profit margins, I've given it such a haircut, because here's on average, folks, you're usually seeing around 20% profit margins with Intel. And last year it was around 12%. So I said, screw it, we're gonna do those same numbers again. And the same thing with the free cash flow margin, same thing, because based off the 5 and 10 year numbers. And the price of free cash flow and PE ratios, yes, they are sitting in a rough territory because of that ultimately their decrease. But I've done 14, 16, and 18. I think that's more than fair and probably pretty lenient for a tech company to sit at that amount, as well as a desired return of 13%. I'm going to click calculate. And folks, if you're enjoying the video so far, hit that like button and subscribe button. It means a lot to me, it means a lot to the channel. The software I'm using is a quick screener tool. It's a phenomenal piece of software. It's called StockSpect. 7-day free trial. Follow the links in the description box below if you want to get your hands on it. So I put that information in. The software is going to crush the numbers. And basically, based off these numerics here, the average calculation comes out to be $35. So keep that in mind, folks. Currently, we're sitting at $39.16. Average calculation comes out to be $35, $33 right in the middle, and on the high side, $52 for this company if you think it's going to grow 7% a year from this point forward. So what does that mean? With the margin of safety I've given, we're pretty much almost near that fair value for Intel. So $35 and below is a sign that maybe we should possibly go in on this company. Now, you may say, Leo, you know what? I'm fully in on Intel. I'm fully in. I think it's going to grow way more than 7%. Then if you're using this software here, you can plug your own numbers in and see what the numbers come out for you. And guarantee if you put higher numbers in, you'll probably have a higher price output for this business. But I think it's currently, I mean, listen, I like buying below the moderate and between the conservative and moderate average. If it's somewhere in here, like $30 a share, to me that makes the most amount of sense, because I know I'm giving myself the most margin of safety. But you know what? It very well could be in here and be totally fine with it. So right now it's $39. If the price comes back down to $35, I'll probably be picking up some more shares. And look, we were at, just in September last year, we were at $30. We hit a low of 25, as indicated here, the 2-week range. I know I picked up some shares back then, but now we're on this little bit of an upswing. Does that mean this upswing is going to continue? It's hard to say. All I know is based off the numerics of the business and where I think it's going to go going forward, $35 makes the most amount of sense. That's the video, folks. If you found it helpful, I'll see you in the next one. Make sure you hit that like button and subscribe button. Thank you so much.